So Matt, so we're talking about the VA assumable loan, right? So, and in short, before we deep dive this, an assumable loan means you're just taking over the payments. Okay, now this may vary lender to lender, and we'll go over the details. But the veterans loan is 100% financing, and when a veteran gets this loan, they can sell their home, and you, an everyday person, non-active military, non-veteran, can actually take that loan over when qualified by the lender. So you do not have to be a veteran. So that's one of the biggest points here. But first off, what can you tell us in regards to the VA loan, right? Like, what do we need to know about this? Like, what's the caveat here? What's the catch?
You assume a mortgage of somebody else. So, why would anybody want to, why is that a thing, right?
Yeah.
Really, I get that question a lot. Really, this happens. And if you think about it, the bank that gave the money to begin with, if you sell your home and you pay off your mortgage, they're missing out on all that interest that they were planning on picking up from for the entire term of the mortgage. So
That's right.
that's where banks really look at this and go, does this make sense for us to allow somebody else to, we originally gave it to this person. They're selling their home. The customer that's buying the house, that's trying to assume the mortgage, they have to apply with the current mortgage company of the loan that they're assuming. So
That's
they
right.
have to apply and they have to qualify for the terms that were set up that they're trying, that were originally meant for the seller of the property and the
Yeah.
current owner of the loan. So, be prepared for that. With that being said, the VA rates are the best in the market, comparatively from back when rates were that low, they were the best on the market. And
Mm-hmm.
now, even though rates traditionally all around are higher, the VA loan is a really great loan when it comes down to interest rates.
That's beautiful. And there's no PMI. The VA assumable loan rate is at 4%, and they owe $390,000, right? So how much money, Matt? 550 is the price, 390 is the VA assumable. How much money does that borrower need to be bringing to the closing table to take advantage of this VA loan?
Well, they'd have to cover the difference of the purchase price and the assumed loan, which would be $160,000. So that's the catch, is that yes, you get a great loan, yes, you get a great interest rate, but they're not the bank that already has the mortgage that the buyer is trying to assume is not going to increase the loan amount and go back to $550,000. It's not just securing the rate; it's the securing the money that the rate is associated with. So
That's right.
they would take over the $390,000 mortgage. They would have that payment that would be pending that they qualify for it all. But the buyer would have to cover the difference and bring that to the closing table. Now, you could potentially take out a second loan for the 160, if you will, or maybe even
Who
100, or
who's
with,
going to underwrite that though? Who's going to
with
take second position?
what I would ask about the bank that you're assuming the mortgage from, if they have anything to help,
Okay.
maybe assume that first mortgage for 4%, and then see if they have a second lien option at market rate or whatever. But it's still not 390,000. It'd be 100
Yeah.
grand or 75 or whatever you're willing to come up with the difference. And here's something that I really want to get out there, is that do not assume that it's going to be easy to assume a mortgage. Do
That's
not
right.
assume that. So you should be pre-approved first for a
Mhm.
regular standard current day mortgage. And in the event that the assumable mortgage doesn't work out well, maybe the numbers don't make sense, or the bank won't sign off on it for one reason or another,
Yep.
you have your backup plan that was already vetted out. So people should still be getting pre-approved for today's mortgages. They should still be ironing out with a loan officer to figure out, down payment, closing costs, taxes, insurance, the process that needs to be done. Because you cannot assume you will assume a mortgage. It's doable, it's possible, but you do not want to bank on it, because for one reason or another, it might sound good at the beginning, but then it might not be something that you can do to pull off. So you want to be prepared.